let me talk about the government functions and scope. In this, firstly, I am going to discuss about the government budget. This has two parts. One is revenue, another one is capital. In revenue there are receipts, another one is expenditure. Again here receipts and expenditure. In receipts, what they get from the economy, that is the tax revenue, another one is non-tax revenue. In tax revenue they have direct tax, indirect tax, custom, excise, direct, corporate, and then income tax. Here in this non-tax revenue, they are grants, they don't incur interest rate, and then dividends, maybe they have invested in any stocks, PSUs. And then the third one is interest payments. They also get the fees, payments from socio and economic services like schools, hospitals, railways, etc. These two is going to be a part of this revenue receipts. Let me come to the revenue expenditure. In revenue expenditure, we have two parts. One is planned expenditure, another one is non-planned expenditure. In planned expenditure, maybe the different policies, schemes, expenditure, they are planned, so they can adjust the budget moving forward. In non-planned expenditure, we have salary, the government employees salary, and then pensions. Another one is subsidies, food subsidy, fertilizer subsidy, and then what we pay for the interest. And then another one is defense expenditure. These are going to be part of the expenditure, revenue expenditure. In capital expenditure, capital budget, we have capital receipt. One main difference between this and this is in capital receipts, assets reduce, debt increases. This is the opposite of this. In capital receipts, what they sell the shares, government shares, that is asset only, asset reducing, debt, they raise the money from the market, maybe government securities or ways and means advance, or maybe from international institutions like World Bank, ADB, or IMF. These are going to be a part of this debt in capital receipts. And then let me come to the capital expenditure. Here they are going to make an expenditure on development, mainly a development, that is public public schools, public hospitals, roads, railways, part of infrastructure. They are durable assets. And then let me come to the discussion of different terms. One is fiscal drag, another one is crowding out effect. In fiscal drag, fiscal means government, monitor means RBI. In fiscal drag, the purchasing power of the people with increasing income is going to reduce, because if your income increases, so the tax will be increased also. So the disposable income with the individual is going to reduce. And also in crowding out effect, if government takes a loan from the banks, commercial banks, then the industries are not going to get enough loans for the investment. If no investment, there will be no factories set up. No factory setup also going to affect on the employment, also productivity and all. And then let me discuss about the different types of taxes based on income. One is progressive tax, another one is regressive tax, third one is proportional tax. In progressive tax, if your income is going to be rising, then that income tax is also going to rise. You are going to be in the different bracket, but a different bracket has different income tax. In regressive tax, it does not matter you are poor or rich, all are going to be taxed the same. For example, GST. In proportional tax, it depends on the income. Proportional to income. Then we move on to the how government raises money. Government raises money from the RBI market. From RBI ways and means advances, they have to pay back within 90 days. Otherwise the amount of loan will be reduced in the subsequent lending. In market, there are short-term as well as long-term securities, government securities. Also, there is NSSF, National Small Savings Funds. They includes PPF, Sukanya Samruddhi, post office deposits. All this will be accessed by the government by providing government securities. Here the short term, In short term, there is two types. One is T-bill, another one is cash management bills. In long term, government state development loans.